So Global Endowment Management is an outsourced chief investment office based in Charlotte, North Carolina. We've been in business more than 15 years, and we work for endowments, foundations, family offices, and other long-term investors. Our roots or our heritage were really in the leading university endowment space. We spun out of Duke in 2007 and really wanted to bring the attributes of those leading endowment offices to other nonprofits or asset owners that wanted to model themselves after some of the success that those offices had. They were leading in the way in which they accessed managers through their networks, the way they scaled, and also their governance model, which we thought was very important to bring to bear on these smaller institutions so that they could have strong long-term leadership over a perpetual time horizon. You know, it's interesting, we're finding ourselves in a period of higher inflation for the first time in, frankly, 40 years. So most investors that have been active in institutional investing have really not even operated in that kind of dynamic. Higher interest rates typically mean that returns looking forward are going to be lower. It's a headwind for risk assets. So private investments play a very important role because typically you receive an illiquidity premium for locking up your capital for as long as 10 years. They tend to be more differentiating in the way in which the managers invest the capital, and relationships, sourcing those managers tends to be a very, very important indicator for how successful they'll be longer term. So at GEM, we focus more on the small buyout side of the market for a couple of reasons. One, during economic downturns, small buyouts typically are more resilient. They sell off less and they rebound more quickly. Two, it's one of the areas where there's actually a tailwind. There's still more applications for new businesses at an all-time high than there has ever been before. Whereas public markets are actually shrinking. The number of companies in public market space is less than it was before. So more opportunity set. In fact, 85% of businesses are actually generating less than $1 billion in revenue. So there's a lot to choose from, if you will. And moreover, only about 20% of private equity dry powder has been earmarked for funds that are less than $1 billion in size. So we really like that dynamic, and we think it leads to a higher probability of success in that market. We tend to source managers that are nimble, that invest at lower market multiples typically for the businesses they acquire. That's important because they aren't as dependent on leverage. They can use less leverage in a higher rate environment, which means better outcomes for investors like us. And finally, they rely on their operational expertise to really drive earnings growth as opposed to financial engineering. So that typically leads to better company performance, which means when they exit those investments, they're paid a higher profit margin for them. That's such a great question. Right now, we are experiencing volatility in the investment markets, again, at an unprecedented rate, simply because we finally have higher interest rates, which are causing lots of dislocation. A lot of institutional investors have very rigid approaches to the way in which they invest. They have clearly defined asset classes, and they, in our terminology, fill buckets, if you will. They invest to a certain target, regardless of whether or not that strategy happens to be the most attractive given the market fundamentals. We have a more flexible approach, which we think is important because you need to be nimble when you're operating in markets like the ones we have today. So we actually use factors to express how our underlying managers and their strategies are going to actually perform. So for example, when you're looking at commodities, one might think you just invest in a commodity index across publicly traded commodities. It's a very simple approach, but they've been underperforming dramatically more recently and have had a lot of volatility. We can express our view on commodities by investing in Washington carbon credits, for example, as a way to express that. There's not an asset class definition for that. It does skew towards commodities from a factor perspective, and we just think it's a smarter way to allocate given the headwinds that you're seeing for commodities. Another example would be in real estate. So typically, large institutional investors would just allocate to REITs as a passive, publicly traded real estate investment. We vacillate between public and private, depending on how fundamentals work. But more importantly, we tend to really traffic in niche opportunities in private real estate, sort of off the beaten path, if you will. So our investments have been in affordable housing, for example. We've been investing in cold storage. We've been investing in self-storage. These are areas that happen to be winners post-pandemic and have not had any of the headwinds associated with office and work from home dynamics, as well as retail, for example, which was really severely hurt. So I think the bottom line is we have to have a flexible implementation model to be able to take advantage of whatever opportunities present themselves in times of market dislocation and not be too dogmatic about how we define certain investments or asset classes.